What's up, everybody? Today, I'm going to talk about how to maximize your FHA loan approval, but also what's truly affordable if you're buying a house in Denver using an FHA loan in 2025. We'll go through an analysis where if you have a kiddo in daycare, you'll see how much it affects your affordability. First, let's get into kind of some things to know about FHA loans. And by the way, my coworker is over here sleeping. If he wakes up and the post office mail truck comes up or UPS comes up, then there'll be a little bit of sound in the background as he says hello in his own special way. So check this out. So as we get into this, I think it's important to understand some things that are misunderstood even by lenders relating to FHA loans. One of the things that commonly comes up is how much do I qualify for? So to talk about that, I'm going to give you a little bit of background and education. There is that mysterious thing called debt ratios. So within debt ratios on an FHA loan, you have actually two parts to this debt ratio. You have a housing expense, which is just the mortgage payment, principal, interest, taxes, insurance, and monthly mortgage insurance, HOAs. And then you have your total debt ratio, which includes all those consumer debts plus that house payment for your total debt ratio. So the magic number, all things constant, would be that housing ratio staying under 47% and the total debt ratio under 57%. I know that sounds wild. That doesn't mean you can afford it. That doesn't mean I'm saying go out and spend everything on the house payment. I'm just saying that what the debt ratio tolerances are that I have seen over time. And we have a client right now doing it. And we have deep counseling sessions about, is this affordable for you? Because this is important. So those are the debt ratios related to FHA loans and what can be approved under normal circumstances. There are things that will add to that, such as if you have a bunch of extra money in savings, you are likely to get that higher debt ratio approval. If you've had some missed payments in the past, have some hiccups on your credit, don't have a lot of money in savings after closing, you might not get that debt ratio approval. So make sure to talk to your lender about this. But first, go through the affordability exercise on what actually is truly affordable in buying a home. Because I always say to everybody, do you want to buy a house and eat ramen? Or do you want to buy a house and still save for vacation and retirement and the future? You have to decide, but it is expensive out there. So let's keep going. Let's talk about a very fun topic for a lot of people, student loans. So how do they calculate student loan payments into the debt ratio? So if a payment is deferred, they're going to go off of a 1% calculation of the balance into that payment. They used to go steeper, but this is not commonly done because more often than not, now a lot of student loans are in repayment. So they're going to go off of what's on the credit report. But if no payment is posted, we're going to use a 0.5% of the balance. So that was something that when FHA made that change, it actually helped out. As I would have said, if they were using 1%, whoever pays off a student loan in 100 months? Nobody, said everybody ever. So that's the thing about student loans. So they will factor in a payment regardless, but what amount? If it's not on your credit report and you're looking at this stuff on Credit Karma or any of these scoring models that y'all look at your credit reports on before talking to a lender, make sure to bring it up, because if it's not reporting a payment, that 0.5% number can help you in terms of qualifying with your FHA loan. All right, let's talk about something that's happening a lot here in Denver, job changes, okay? So if you change jobs, you're talking to a lender, have these conversations with them. I hope you trust them enough to share that, hey, I'm thinking about taking a new job. How will this affect me? Why do I bring this up? Because you don't want to be surprised, write a contract, fall in love with the house, and find out it's no longer going to work for you. If you're in a salaried position and your new job is salaried, you're going to be okay. They will want the offer letter. They will want to make sure that all those things that are on that offer letter are satisfied. So if there's a background check, anything like this, that is going to be necessary. And then, of course, having started the new job is important before closing as well. But talk to your lender. Now, those of you that work hourly, and that could include if you think you have a salary, but they actually pay you hourly over 40 hours a week, you're an hourly employee. That is variable income. Why does that even matter? Because if you change jobs and if the hours don't vary, meaning those pay stubs now show 40 hours, 40 hours, 40 hours, they're just going to use that income off the pay stubs to qualify. But if they vary, this is where it gets murky. And it will come down to the average over the last few years. So make sure you talk to your lender, especially y'all who are paid hourly. Make sure to talk to your lender if you're going to change jobs so that they can keep you safe and you can get closed on that house that you fall in love with when you go to write an offer. So we've talked about debt ratios, student loan payments, job changes. Let's talk about income further. Let's talk about overtime, bonus, and tip income. As long as you've had it for a year, so now you hear about that job change. If you have that type of income, you may not want to change jobs if you're buying a house, because then the underwriters will want time at the new job because they don't have a history of you getting overtime or bonus or tips at that new job like they did at the other job. So keep that in mind. But you're going to want to see at least 12 months, not necessarily 24, but it's got to show that it's stable, growing, and going to continue. So your employer actually has to show, click, yes, it likely is to continue, but this is an underwriting decision. So talk to your lender about these types of income if you have them, to make sure that they can be qualified for you regarding your debt ratio. So biggest takeaway about job changes, talk to us, talk to the lender, bring it up, ask them so that you're safe and you don't get sideswiped when you're out looking at houses, but that better job comes along that you just can't pass up to take the job. Now, I did say I was going to talk about affordability. So I'm going to talk about if you make $175,000 right now. Rates are on FHA rates are setting just sub 6%. Okay. And here comes that mailman. So my coworker's about to go. So hang with me. You make $175,000, roughly 6% rate. And let's say you have $750 a month in obligations. In addition to that, let's say $700 a month will be for escrows for taxes and insurance on the house. Ironically, I would say you could qualify for a $760,000 house, but if that payment is $5,450 a month, give or take, can you afford it? Probably not, but have this conversation with the lender. This is an important conversation to have, is affordability. I'm going to share with you though, for all y'all out there, I had them in the past where my kiddos were in daycare. Let's say $2,000 a month, because from my research, that's about the average in Denver for daycare, $2,000 a month. Take that same $175,000 a year of income, and in this case, you now can afford likely a $450,000 home with a $3,450 payment. Is it affordable? Is it not affordable? There are those sneaky expenses that you have to think about when budgeting for a home. And just because the debt ratios work does not mean it's something you can afford, even if you can qualify for it off the things I talked about regarding the top debt ratios. Hey, I've got tons of videos on the channel that are meant to be educational by nature. Definitely some great ones related to FHA loans out there. For those that are self-employed, I got a great video for you. I've got a great video on closing costs and hidden costs to understand what those loan estimates actually are showing you for costs. So make sure to check out some other videos if you like educational content. If you want to have a consultation on your one-on-one scenario, schedule with me, calendly.com/mortgage maestro. I'll catch up with y'all soon and we'll talk to you then.